You may have heard someone online say an S corporation could save you thousands of dollars in taxes, or you're paying too much taxes because your LLC isn't taxed as an S corporation. Those statements can sound very convincing, but where do those tax savings actually come from? Does becoming an S corporation lower your income? Does it give you a special tax rate? Or does the IRS simply stop taxing part of your profit? The answer is none of those. An S corporation generally doesn't reduce your business income. It changes how part of that income is treated for employment tax purposes. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS rules. Let's break this down. In the last video, we learned that an S corporation owner wears two hats, an employee hat and an owner hat. Those two hats are also the key to understanding the potential tax savings. Let's go back to Jane. Jane owns a home care agency. Before electing S corporation tax status, Jane operated as a single member LLC. Suppose her agency collected $250,000 during the year. After paying caregiver wages, insurance, software, marketing, office expenses, and her other business expenses, the business had $100,000 of net profit. As a single member LLC, that business profit is reported on Jane's personal tax return. Jane generally pays income tax on the profit, and because she's self-employed, the net earnings are also generally subject to self-employment tax. That self-employment tax helps fund Social Security and Medicare. Now, let's see what changes after Jane elects to have her business taxed as an S corporation. The agency still earns the same amount of money. It still pays its business expenses, and Jane still pays income tax on the income that passes through to her. The S corporation election does not make the business profit disappear. Here is what changes. Because Jane works in the business, she puts on her employee hat. The S corporation pays her a reasonable salary through payroll. Let's say for this simplified example that Jane's reasonable salary is $60,000. That salary is subject to payroll taxes. Jane receives a Form W-2. The employee portion of Social Security and Medicare is withheld from her paycheck, and the S corporation pays the employer portion. Now Jane puts on her owner hat after paying all of the expenses. Suppose the business still has profit remaining. That remaining profit passes through to Jane as S corporation shareholder. Jane generally still pays income tax on that pass-through profit, whether or not she withdraws all of the cash. But that remaining S corporation profit is generally not subject to the Social Security and Medicare taxes that apply to Jane's wages. That difference is where the primary federal tax advantage comes from. Let me say that again, because this is the part many business owners misunderstand. The shareholder distribution is not automatically tax-free. Jane generally still pays income tax on her share of S corporation's taxable profit. The potential savings come from not paying Social Security and Medicare taxes on the portion properly treated as S corporation profit instead of wages. So in our simplified example, Jane's salary is subject to payroll taxes. The remaining pass-through profit generally is not. That separation creates the potential tax savings. But there is one important rule. Jane cannot pay herself an artificially low salary just to create a larger distribution. If she works in the business, the S corporation must pay her reasonable compensation for the services she provides. The IRS can reclassify distributions as wages when reasonable compensation has not been paid. We'll explain how reasonable compensation is determined in the next video. Now, let's answer another important question. When does an S corporation begin to make financial sense? Think about three numbers: your total business income, expenses, reasonable salary the business would need to pay you. After accounting for those three numbers, is there enough profit remaining to create meaningful payroll tax savings? If there is little or no profit remaining after paying a reasonable salary, there may be little or no tax advantage. For example, suppose a business earns $60,000 after its ordinary business expenses, and suppose $60,000 would also be reasonable compensation for the owner's work. There may be no meaningful profit left to treat differently. The owner has added an S corporation but may not have created meaningful tax savings. This is why revenue alone does not determine whether an S corporation makes sense. A business can collect hundreds of thousands of dollars and still have a small profit after paying all its expenses. The analysis must be based on profitability, not just revenue. And there's another side to the calculation. S corporation creates additional costs and responsibilities. You may need payroll software, more detailed accounting, a separate Form 1120S tax return, reasonable compensation research, professional tax preparation, and ongoing compliance throughout the year. Depending on where you live, your state may also charge an S corporation tax fee or minimum franchise tax. Those costs reduce the net benefit of the election. So the right question is not how much could an S corporation save me? The better question is, after paying my reasonable salary and all the additional costs, how much would the S corporation actually save my business? There is a calculation that matters. Here is my professional tip. Never elect S corporation tax status based only on a revenue threshold you heard online. You may hear someone say, elect an S corporation when you reach $50,000, or every business earning $100,000 needs an S corporation. Those statements ignore too many important facts. Two businesses can have the same revenue but completely different expenses, profits, owner responsibilities, state taxes, and reasonable salary requirements. One may benefit from the election, the other may not. Your decision should be based on actual comparison using your business income, expenses, your reasonable compensation, your state tax rules, and the additional costs of operating the S corporation. If you remember just one thing from today's video, remember this: S corporation does not make your income disappear, and shareholder distributions are not simply tax-free money. The potential savings come from separating reasonable wages, which are subject to payroll taxes, from remaining S corporation profit, which is generally not subject to self-employment or payroll taxes. But that strategy only works when the business has enough profit to pay a reasonable salary, cover additional costs, and still leave meaningful profit remaining. In the next video, we're going to answer the question at the center of this entire strategy. How much should you pay yourself as an S corporation owner, or as the IRS calls it, what is reasonable compensation? I'll see you there.